What we do at CAS is not perfect, but it is proven.
Understand the risks. If we can live with the worst case, the upside takes care of itself.
There's 1 to 3 key levers that are going to determine your outcome on that investment.
So look, we're going to shift gears here for just a minute. We're going to focus in on some specific themes and do a little bit more of a deeper dive. So Christopher, most people know that the growth of private assets is our largest theme. But take us back to the early days, 10 plus years ago. How did that theme develop, and what was it like making those initial investments in GP stakes?
So a couple of you, obviously, some of you from the very beginning know this, but in 2004, I created an organization called the Texas Hedge Fund Association. Changed the name over time to the Texas Alternative Investment Association. But because of the fact that I was the chairman of this group from the state, we looked at hedge funds and then ultimately private equity funds. And what we saw is more and more institutions just allocating capital to alternatives. More and more firms or endowments or foundations or pensions, et cetera, that were just increasing from a 5% weight to a 10% weight to a 15% weight. And it was very clear that there was this big movement. And David Swensen obviously had become very, very famous, showing the benefits of the diversification. It had taken, since Markowitz won the Nobel Prize basically in 1990, if I remember correctly, that it was another decade or so before the institutions really embraced that. And that started in 2000, then it started to grow, and more asset classes developed. Well, we really believed in that theme. There really wasn't a definitive way to take advantage of it. And then the industry started doing this thing called GP stakes. Well, GP stakes initially were all done with hedge funds because those were the largest at that time, or at least the most interested in doing a transaction. And we looked at first couple of funds that were doing that, and we passed on all of them because it's really a binary outcome. If you're running a hedge fund, the business model is after 2 years, if you make a lot of money, you're going to make $1 zillion, and after 2 years, if you don't do well, you're going to be out of business. We just didn't like that binary outcome. Well, we were introduced to the team at Dial, now Blue Owl, and we learned more about what they were doing, and then sure enough, Vista did a transaction, and then the NCAP team, and I don't know if any of the NCAP team is here right now, but all 4 of the founding partners of NCAP were shareholders in CAS, so we're obviously very close to them, talking about the network effect. In that situation, they did a transaction with Dial, and then we saw Starwood do it. And we was like, okay, this is interesting because of the fact that the business model is as good as any business model you will ever find. Your clients can't fire you, they can't get out, and you're going to get these contractually obligated management fees that all of you have heard us talk about before. But that was an absolute no-brainer. And so for us then, the opportunity to do an advantage business model and to be able to do it in a unique way, and we joked earlier upstairs, but we all just messed up. If you haven't watched the Holy Grail of Investing podcast that we did with Michael Reese, we all messed up. It shouldn't have been called GP stakes. It's really GP growth capital. So if you have advantage businesses that want to grow and want capital to help them grow, you are going to do that in a totally aligned way. That's a really good business model. And so that's what we did. And we recognized that it was going to continue to evolve. And we've obviously grown to be the largest. And it's an area that we still have tremendous confidence in.
Clearly, looking backwards, CAS was a first mover and has become the largest in the industry. I don't know if everyone in the room knows, but CAS was just honored to be named the GP Stakes Limited Partner of the Year in 2025, which we're very proud of. But if you can, going back 10 years and looking forward, could you have imagined the growth that we've seen in GP stakes?
I mean, I really could, because at the time we got involved, literally it was a $12 billion industry. Just think about how small that is. Again, 12 billion is a lot of money, but 12 billion compared for an entire asset class. And it's just because there really had not been a lot of transactions done. And once it became clear that you could actually accelerate your growth by solving for some of the challenges that you needed growth capital to solve for, that obviously became like the total addressable market was enormous. So we're roughly 130 billion now, so up 11-fold in whatever it is, 12 years. But it doesn't surprise me. And I think it's going to continue to grow significantly as an asset class because, again, the total addressable market's so big.
Very good. We want to talk a little bit about professional sports. Again, shifting gears, professional sports is not the theme, But you might find it surprising that this group doesn't always agree on everything, at least not initially. To move forward, we need consensus, right? But we have a CAS promise that says, I will embrace a culture of, embrace and promote a culture of healthy conflict. And you might say, well, why is that so important? We look at it every day on our desk. It's because every successful organization needs candor, but also needs collegiality, right? And probably no place more importantly than here.
So every Monday morning we have cage fights.
Whatever it takes.
Those are on Tuesday.
So sports, there was not widespread agreement on the IC. And in fact, it was a very contentious subject for over a year. So Matt, why don't we go to you first? What did you see in the asset class that caused you to stay with it for that length of time?
Yeah, I thought it was kind of a no-brainer pretty quickly. And Tim, it took 2 years to get across the finish line only. 2 years from our first meeting with Arctos in 2019 to finally make an investment in late 2021. Look, I got very convicted pretty darn quickly on sports. And I saw a lot of parallels between sports and GP stakes and some of the elements Christopher mentioned. I looked at it through two lenses. The asset level, so what is the business of being a franchise owner in sports? And then an investment lens. What are the characteristics about making an investment in this space that differentiate it from others? At the asset level, you have an amazing list of traits. You have something we all want, which is really long-term, contractual, recurring revenues that in the case of sports last 10 to 15 years, through media and sponsorship deals that are extremely long-term. You have incredible growth of that revenue over time. You've never seen, actually prior to COVID, had never seen a single year that revenue declined year over year, whether it was through recession or even through the GFC. One of the other things I loved is that you had no leverage or very low leverage that was mandated by the leagues to not take on more than a very small amount of leverage. And for us at the time, this is 2019, 2020, interest rates were very low. Something that we were very focused on was avoiding becoming the equity holders in companies that were taking a lot of floating rate debt on because we were concerned about the ramifications of that once interest rates ultimately went back up, right? So very concerned about that. So love the low leverage. You also had incredible kind of operational business things. You had incredibly loyal customer base. We call them fans, right, that keep coming back year after year to give you more of their hard-earned money. You had a legal monopoly to operate in your geographic area, which is pretty nice. You also had a really strong moat around that geographic monopoly. You've actually only seen 4 new franchises in North American sports in the last 26 years now. So they just don't make very many of these things, and there's not new competition coming at you every year to disrupt your geographic region. So you had this incredible list of things. On top of that, in 2020 and 2021, we all became very focused and concerned about inflation. You had really attractive inflation hedging characteristics, one through the pricing power for your loyal customer base, but also through hard assets in the form of very high quality real estate in the way of stadiums and arenas and adjacent real estate around that. So lots of great things to love at the business level. At the investment level, perhaps even more so, sports are not correlated to anything else out there. They're not correlated to macro factors like growth in GDP. They're not correlated to interest rates or changes in interest rates. They're not correlated to other investments like the S&P or bonds or commodities or even other private market strategies. So they're one of the few things in the world that can actually both be a risk reducer and a return enhancer in a diversified portfolio, something really, really hard to find. And then you also had this unique competitive dynamic. If you go back to the early days of GP Stakes, Christopher mentioned, you had 3 firms in the world that were building dedicated strategies to acquire minority equity positions in institutional private market GPs. If you compare that to something like middle market private equity as an example, where you have hundreds of great firms competing to buy companies and get transactions done, that creates a very different competitive dynamic. Even today in GP Stakes, you have less than a dozen. In sports, in the early days, you had one. That was Arctos, one firm that was approved by the leagues to transact in multiple teams and multiple leagues. That makes for a very attractive competitive dynamic for us as investors. So I'm just sort of going down the line, and every box is being checked. It's becoming amazingly obvious that we should be doing this, right?
However,
Why didn't we do it? We should have done that.
Yeah.
Became a no-brainer for me, but for 2 years, we sat in investment committee every 2 weeks, and I told Christopher, dude, how are we not on the same page about this?
Well, Matt, we call that the defense rest. I think you've made a very clear and compelling case, but we're going to flip it over to the prosecution for the other side of the story. Christopher, you had a different view.
It's interesting because it's something to learn from that I started to even say earlier, but all of us bring biases to evaluating investments. We love the ones that look like the ones that worked for us in the past, and we dislike the ones that look like the ones that didn't work for us in the past. That's human nature. Well, in my case, as an athlete, college, and coaching high school football, et cetera, I looked at, and particularly because of my age and me growing up around the world of sports, for most of my lifetime, sports were nothing but a trophy asset, right? A bunch of very wealthy people bought them because they wanted to be able to say they own the team, they bled cash, and they hoped they would go up in value, right? So that's what I thought of. And the other thing goes back to something we did talk about already, which is, what's the theme? And I joke with Ian, and I have to be careful when I joke with Ian because of the fact that he's a really big dude, for those of you that know Ian. So, but he literally came and met with us like 6 or 7 times, and he never understood the way that my mind thinks, which is, how does it work from a thematic perspective, not just a cool thing to own? And it wasn't until really the light bulb went off for me was when we realized that the theme involved was cord cutting. Because that's a no-brainer, that cord cutting is going to continue, and if you want to advertise to people at a live event is the only way you're going to reach them because of cord cutting. Well, what's the best way to do that? Own the people that are providing the content and their monopoly and all the other things that Matt articulated very well. That made sense to me. But the thing that really got me over the final finish line was that, and I joke because it's just something that I didn't get. Maybe they told me and I didn't hear it. I don't think they did. They think they did, but I still don't. It didn't convince me.
We did.
But when I finally realized, and when it really made sense, is you have this big theme that is a no-brainer, and you have this defensive characteristic because it doesn't matter your performance on the field. It doesn't matter in the NFL if you're in the Super Bowl or if you literally were last place. Next year, you're going to receive a check for well over $400 million before you ever play a game. Well, that's when it really got my attention. That's when I dug in and said, okay, this is a persistent theme and there are moats. And if you look through the 10 things I showed you earlier, it checks the boxes on all of them. And that's why obviously we did lean in, and now Ian has told me that we're the largest LP in the world of professional sports.
Wow.
So we took a while, but we kind of went all in once we did.
Well, can I thank Matt on behalf of everyone in the room that you persisted? So, Christopher, I do want to stay with you, though. We'd be remiss if we didn't talk a little bit about energy. We're sitting here in Houston, the energy capital of the world. Kaz has invested in energy, allocated energy for a long time. How did you get started investing in energy?
So that one's a very short, simple answer in that, the power of the network is the network. I mentioned earlier that the 4 founding partners of NCAP were shareholders. And Bob Zork, who I don't think is here right now, but Bob was on our board for well over a decade and was kind of our lead board member. And a big part of the board's role is not only to keep an eye on their own investments, but also to help share ideas, what they're saying. They're very wealthy individuals. They see a lot of transactions. They're very wise in what they do. And one day Bob says, Christopher, have you all started looking at shales? And I said, what, are you talking about like granite countertops? I mean, what are we talking about here? I'm not remodeling the house right now. I will be soon, but is that what you're talking about? And he goes, no, this is a little bit more important than that. And he explained this concept of the shales and what was going to happen in energy. And he actually did use the tabletop as an example. Imagine you can't drill this way, so you're going to come in the side, you're going to go around this way horizontally, you're going to find this reservoir, you're going to pull it out this way and bring it up like, oh, that's kind of cool. So that was how we got introduced to really the energy evolution, as the way that we were doing things in the past was changing so rapidly, and that's obviously why we jumped in.
Amazing story, and the energy industry has just changed so dramatically from a technology point of view over from that point of time since. Mark, it's a good example of like these themes aren't static, right? The world changes. So how has the energy theme for CAS evolved over time?
So looking around the room, there are some people here who have forgotten more about energy investing than I will ever learn. And I'm very cognizant of that. So I don't mean to insult your intelligence, but I also don't want to make any assumptions about what people know. So you've got upstream business is finding it in the ground, getting it out of the ground to the wellhead. Midstream is taking it from the wellhead to somewhere that's going to be processed for some purpose. Downstream is the processing. And then there's other areas around it, okay? So our initial involvement, going back to Christopher's conversation, was there's this new development that's going on in these new basins with shale, and so they're going to go drill for it. And you take a lot of commodity risk, and there's a lot of big hits that come with that, up and down. Midstream is the infrastructure that they use to take the oil out once they already have it. So our initial play was actually in the midstream side of the business, was just simple connecting pipes, storage facilities, processing out in the field to get it to a bigger pipe to go take it somewhere where it's going to be, processed. That's the midstream side of the business. Then you have this, that was like 08 to 2014, I want to say. And then in 2014, you had this, I think Christopher mentioned a moment ago, you had commodity prices turn way over, oil prices drop. Probably a good time at that point to be drilling and looking for oil and going out and pumping it out of the ground because prices are low, you want to buy, and then ride them up. So then we got in the upstream side of the business. And it stayed that way for several years. And then, coming back to kind of what's our core thesis here is like, the consumption of energy and needing power, and we need energy abundance. We're not anti any specific form of energy. If we're going to invest in it, though, it's got to make money. It's got to make real money. And so we saw an opportunity in 2019, 2020, and then 2021 to get in front of what we believed were going to be significant dollars coming into the alternative energy sources, things like solar, things like batteries, things like different forms of power generation. And so we made those investments. We harvested a lot of those, probably within the next 2 years, 2023, and we've since moved on. We don't find that space that attractive today, generally speaking. Again, not a political statement. This is just about making money. But then since then, we've also now gotten and are heavily involved in what's going on with power generation, right? We think power is an interesting conversation. We talked about artificial intelligence and the need for data centers and what they're going to do for power. So we think power is a good place, along with LNG, liquefied natural gas. So there's, to my point earlier around the different clocks, right? Different fundamentals for different parts of the industry look different at different points in time. Right? And the thing we know is that we're going to need energy. The theme is the evolution of energy. We believe energy evolves, and that's a quick demonstration of sort of how it started in one place, and it's now evolved into it, taking a long, winding turn. Again, our job as the investment committee is to think about that journey and think about the magnitude, think about the sequencing, thinking about how we want to price that at different moments in time.
Perfect. Thanks, Mark. So, staying with you, the CAS network has today, I think Christopher mentioned this earlier, has grown to 8,700 partners across 50 states, 40 countries, many represented here in the room, and we're grateful for your partnership. That's a very powerful information network. Mm-hmm. You mentioned a whole series of changes in energy that we've participated in along the way. How, like with that specific example, how's the CAS network helped the investment committee at CAS kind of navigate those changes? And how does that work in practice?
There's really 3 quick examples that I'll give. The first would be the energy private equity firms themselves. You all heard this 2 sessions ago. I think Christopher was talking about kind of lessons learned and how we do what we do at CAS. And one of the points that he made was about being a great partner to these firms. We don't put people through the same type of diligence process. In some ways, it's easier. In some ways, it's a lot harder to get dollars from CAS. We just ask different sorts of questions, and we try to be a really great partner to them. And so when you call them and you pick up the phone and you reach out and you need something from them or their counsel, they're willing to give it, whether it's we're bidding on a piece of one of their funds in the secondary market, we're looking at something that's tangential to a business that they already own. Because these people, and I don't mean to sound too simple, folks, but because they like us, they help us, right? It's funny how that works. So those energy private equity firms would be like the top of that list. Then you have other sponsors that operate in private equity who happen to have relationships, and they bring those to you, right? 2 of the more interesting deals that we've done in energy, one of them was Calpine, which is a power generation business that recently sold to Constellation. Dial actually called us in 2017 and said, one of the GPs that you own a stake in, which was Energy Capital Partners at the time, since it's been folded into Bridgepoint, they're taking this company private. They need co-investment dollars. We think you guys would be a great one. So we looked at the deal. We made the investment. It's been a great performer for us so that you can triangulate within the industry. And then the last one, folks, is you, right? There are people sitting here right now that I will pick up the phone and I will call because, again, they have forgotten more about energy investing than I will ever know in my lifetime. And so we can call them. These are folks who have made literally billions of dollars for themselves and investors in the energy business and figure out, hey, this is something we're looking at. Will you look at this with us? Will you help us underwrite it? If you like it, then chances are we probably like it. When you have that type of triangulation you can do and those types of relationships of people who want to see you be successful, not just that you're paying a token fee to, but who have a vested interest in what you're doing, it completely changes the game.
Great example, thank you. I want to pivot to something that I think is one of the most interesting and sort of evolving facets of our business that for many of you in the room might be new. Obviously, it's not new to anyone that the secondaries market across private assets has grown extremely significantly over the past few years for a lot of reasons. In GP stakes, Kaz has been involved from the very beginning of the secondary market for GP stakes. So, Michael, if you wouldn't mind, could you take us back to those first secondary transactions at GP stakes? What was that like as that market was in its infancy, and how has that evolved over time?
Yeah, it's important, I think, to take the 30,000-foot view of the asset class before we delve into secondaries to really understand how we got here and why things matter. So GP stakes as an asset class is really only 10 or 15 years old. So it's young relative to most of the other spaces that we talk about and that you'll hear about over the coming days. Pairing that, equity GP stakes by nature are perpetual assets. They're meant to be held forever or for very long periods of time at a bare minimum. Of the $60 billion plus of institutional capital that's been raised in this space to date, a good portion of that has come from institutional investors that invested knowing that the underlying assets are perpetual, but they did so out of vehicles on their end that happen to be constrained by fund lives or something like that. So when you look at the $5.3 billion raised in Dial 3 or the $9 billion raised in Dial 4 as an example, the 10-year hypothetical shot clock is getting pretty close to expiration on both of those vintages. And so the question is, for the institutional investors that became involved, what options are available to them if they need to generate some form of liquidity? Luckily for some of them, GP stakes is traditionally a very strong cash flowing asset, so maybe that cash flow is enough for a handful of those investors. But for the folks that need to force their hand and produce a larger amount of harvest or exit their entire position in a quarter, their real only option is the secondary market. So let's dive into that and take a look at what that looks like. Well, inside of the secondary market in particular, in GP stakes, because the asset class is so young, there really hasn't been that much time to develop any form of mature market where you have a lot of buyers and a lot of sellers and the bid-ask spread, so to speak, is really tight. Pair that with a really important fact that very few people pay attention to, but in traditional secondary markets, one of the benefits of being a buyer is you can acquire an asset further into its life and shorten the tenure that you'd expect to hold that asset. If I buy a 7-year-old plain vanilla buyout fund as an example, I may only underwrite holding that asset for 3 to 4 years until it fully harvests. That's a huge benefit to most secondary investors. If you're buying a GP stake fund in the secondary market, you better be ready to hold that asset forever because, again, the underlying asset is perpetual. And so because of these dynamics, a lot of the traditional secondary players don't really belong in the GP stakes landscape, which provides a really unique opportunity. Add that to the equation, the number of sponsors and vintages in this space are limited. The number of approved buyers that have the ability to acquire stakes are equally limited, and the number of brokers that have been built out to connect parties they're few and far between. So you wind up with what we see today, which is a heavily fragmented market where you have a strong and growing supply of institutional limited partners that need to exit for non-investment reasons, and a very few number of ideal buyers that can and want to acquire more. So in the world of GP stakes, there's not much that's more exciting than GP stake secondaries.
Yeah, I couldn't agree more. And you articulate those very unique features of GP stakes so well. It's really helpful in terms of CAS has now grown to represent 75% of global GP stake secondaries volume. How has CAS's size and scale created advantages for us to kind of leverage our position into a dominant market position?
Yeah, it's an astounding statistic. So really, take a moment to realize what he just said. 75% of global GP stake secondaries volume is dominated by CAS. When you rewind the clock 8 years, when we looked at our first GP stake secondary, that entire year, 2018, I believe, we probably looked at a total of 2 to 3 transactions. We see about 2 to 3 a week, and sitting here right now, I have 7 on my desk that we're underwriting currently. So the volume has expanded.
You better go.
I know. Seriously. The volume has expanded dramatically, and CAS is positioned as an ideal buyer because of all of the attributes that I just mentioned. So we've really been able to command our way to a place where we are now the first call in almost every transaction, whether it's a broker, it's a sponsor, or it's a limited partner that needs to generate some form of liquidity for some party involved. We know the assets like the back of our hand. We have relationships with the sponsors as close as anyone on the planet. And in many cases, we actually own direct stakes or co-investments in the underlying assets on a look-through basis. So there's really no one that's positioned better to know exactly what these should trade for, which allows us to be a very quick no in circumstances where price is not a fit. It allows us to be a very quick yes where price is a fit. And it also allows us the opportunity to utilize unique payment structures to help meet the needs of sellers while also enhancing our own IRR. So there's a lot of flexibility on our side, and the results speak for themselves. We've transacted on roughly 25 individual GP stake secondary transactions. That spans nearly $1 billion of value, and those individual deals have ranged as small as less than $1 million and as large as $500 million, the world's largest GP stake secondary ever. In essence, we are the 800-pound gorilla in this space. Because of our size, our speed, our scale, our flexibility, our knowledge, we're able to structure transactions and produce results that really no one else could.
Just a great example. So thank you, Michael. And before we move to kind of wrap our session, Mark, I want to come back to your comments earlier about the power of the CAS network. Mm-hmm. You talked about energy specifically. Are there other industries or asset classes where the investment community can really leverage that built-in informational advantage?
Yeah, really briefly, I think you have to ask yourself, what are the market environments like that most benefit network effects? They're smaller, more niche markets that have repeat players where incentives really matter and you can build real relationships, right? When you have that dynamic, you can harness the power of a network because everybody sort of operates as a community rather than as a bunch of individual players. It's not a surprise, folks, that when you look at GP stakes, when you look at pro sports, and you look at energy, these are niche markets, right? Like as big as they are still very small compared to everything else out there. So GP stakes has grown from $12 billion to $120 billion. That sounds like a lot of growth. There was like $380 billion of private equity buyout money raised last year. So like, it ain't that big, folks. So one area that you're gonna hear more about tomorrow that we're very excited about would be like space and defense. The space and defense industry, it's niche, it's small, concentrated number of players. People really care about it. There's people who are very vested in it, and incentives matter. And so that's an area that I think is going to be interesting to watch and to be more active in.
Really important perspective. So thank you, Mark. I'm glad we had time to go there. So I guess in closing, quick hits, as few words as possible. I'd love to hear from each of you, what's the one thing that sets the CAS Investment Committee apart that has allowed CAS to be so successful over 25 years?
Yeah, I'll start with, just for everyone in the audience, that's middle of the screen, far right. Understand the risks. If we can live with the worst case, the upside takes care of itself. Really, in essence, when we talk about full circle, bringing back to Christopher's opening comments, how do we underwrite 1,500 to 2,000 investments a year across strategy, sector, type, everything under the sun? It is a unifying factor of a relentless focus on the worst case. Not downside, but truly how does something blow up? Because without that, every individual opportunity is its own butterfly, and it's really hard to compare and decide where you want to lean heavily in and where you want to set everything else aside. I'd encourage everyone in this audience, as you run into our sponsor partners who you'll see tomorrow, potentially tonight, ask them, does CAS actually get on the phone and talk about downside? It's a painful subject for them because every time they get on, they want to talk about, the downside's a 1.4x. It's not. There's something here that can blow up. This could be potentially a 0, it could be a 0.8, something like that. But our job is to get them to give us the compliance unfriendly case that they don't want to talk about, but that we need to make effective decisions.
Mine would be challenging the conventional and thinking outside the box. You don't need us to be another source of the same type of information, opportunities that you're getting from the market. You just don't, right? That's well covered. What you want from us is going to be a disciplined approach to seeing around corners, understanding risks, mitigating those by thinking independently than the way other people do. It causes us to come across probably in a different way than a lot of people are used to. It's manifest in the way we operate our business, but ultimately it's challenging that unconventional idea. We're not afraid of the box. We don't want to be outside the box just for the sake of being outside the box. The box can be great, but we want to be excited about the box, not trapped by it. A lot of people are trapped into this little box and they never get outside of it, and this is not the way we're ever going to operate.
Yeah, for me, it's our ability to find what matters, and what we say is see the forest, not the trees. As I said, I joined 12 years ago. I came to CAS from a pretty nerdy kind of math background. Christopher would tell me I was overly analytical, which is not necessarily a bad thing, hopefully. But where I think I've grown personally, where I think we've grown as an investment team, an investment committee, and as an organization, is the ability to understand that in any investment, any asset, any model that you're looking at, no matter how complex, there may be dozens, hundreds, or even thousands of data points for you to consider. 99% of it is noise. There are 1 to 3 things every time that are the key things that matter. There's 1 to 3 key levers that are going to determine your outcome on that investment. And if you can correctly identify those and get those right, you can build a ton of conviction around the investments that you make, and great results will follow.
Thanks, Matt. And before I hand this back to Christopher for the final word here, which I think is fitting, I just want to thank all of you for doing this. I think it's been a great session, and we appreciate your insights. Christopher, how would you crystallize what sets this investment committee apart?
Well, I mean, I think there's a couple things. First is character, right? So all these men are honorable. They're men of very high character. They're not afraid to say what they think. They're not afraid to be independent in their thought, and at the same time to be able to have this very collegial, healthy, embracing that culture of healthy conflict. You know, they're great people that also are really, really smart, and when you can harness great people with lots of intelligence together, good things can develop out of that. Right? So that's the first thing. The second thing is that they have all bought into, and I say this all the time internally, every single one of our new hires, and I know there's some in the room, they'll hear the same thing. What we do at CAS is not perfect, but it is proven. And if you can take a proven process and apply it consistently over time, you get persistency. And that persistency is what ultimately drives the most success over a long period of time through economic cycles in lots of different asset classes. And so the ability for everybody here to think in a similar way about what success looks like enables us to be very powerful to combine everybody's strengths and compensate for their constraints, mine included in that, and ultimately come out with a much stronger overall cohesive result. And people ask us all the time in due diligence, do you have to agree on everything? And the answer is yes. We're not going to do something if half of us think that this is a terrible idea and half of us think it's a good idea. We have to understand what the scenario is and how it's going to come together, and we have to come to that consensus. And if the answer is we have to wait, we'll wait. But then we'll continue to explore. Sometimes it takes 2 years, right? But we'll get there. All right. So the other thing that I would say is that in all aspects, and it's something that most people just don't fully appreciate. When you look at investing capital, we talk about alignment. In every single conversation, it always starts with what's the worst case scenario in. But as we get to the decision time, it is a real simple question. Are you going to put your money in it? If the answer to that is, I think it's a great idea for them, but not me, okay, that's a bad answer. And if we're not all in a position to where we're going to put our own personal capital in this, we're willing to invest our family's future in this opportunity, then we're just not going to do it. And that does mean that sometimes we'll miss things. But it means that we're going to be unified in that our job is to invest our capital, make sure that we're aligned with the people that are in our network. And obviously it's a lot of fun, and we do beat each other up a little bit, but we also have a lot of fun too.